If you were to say that the stock market is extremely unfair, seemingly going against every single trade or investment that you make, you think you're losing because institutional traders are taking advantage of you through $10,000 per seat per month Bloomberg terminal access that you'll never have access to, or the market is manipulated by hedge funds that are trading on a microsecond frequency, you'd be right about all of those things. But you probably clicked on this video because you don't believe it has to be this way. And you'd also be right about that. This right here is my performance over the past year. It's not the craziest thing you'll ever see in the world. I'm not a Wall Street god, and I'm certainly not a day trader trading on the minute, 5-minute, 15-minute time frame. But this is roughly double what the S&P 500 did over that same time span. Now, I don't show you this to brag because it's not very brag worthy, but I do show it to you because it works. Whatever the reason you clicked on this video for, I believe this information will be extremely useful to you. Give me 1 to 2 minutes to try and change your mindset on the stock market overall. Today, right now, roughly 80% of stock market volume is algorithmically traded. That doesn't have to be some super complex machine learning algorithm that Jim Simons helped to create and is doing, 150,000 to 300,000 trades per day. No, it doesn't have to be that complicated. This just means anything that's trading based on a set of rules, a set of conditions. The bottom line is basically all of the trading volume that you see on a daily basis is done by machines, not people. If we look at the equities market, the trend has been in one direction, and that's up. Since 2000, the percentage of volume accounted for by machines has increased tremendously, and today we're sitting at roughly 80%. Now this is you. The other 20%, the working class as I like to call it. I guess you can think of the algorithms as the bourgeoisie, but I promise you're gonna be joining that bourgeoisie very soon. And yes, as you might have guessed, AI is making things even a little more crazy. They aren't just based on price action, they're scanning the news, they're scanning headlines, tweets, you name it. Why do you think the second that Donald Trump comes out with a Truth Social post saying, hey, the United States has won the war, why do we see an instantaneous reaction, a reaction so fast you wouldn't even have received the notification on your phone yet before the stock market is already reacting? Well, that's a machine beating you to it, and that will happen 100 out of 100 times because it's analyzing data and placing that trade within seconds to microseconds. So your natural question is, whoa, how the hell am I gonna outperform that? Well, we're gonna make this really simple and break this down into 4 different categories. 2 of those categories that you can directly take advantage of, and that's how I've seen these results over the past year. We'll go through a strategy that you can steal right now. It's historically very successful. Over the past 6 years, you have over a 70% win rate, an average return of almost 7%. But this is just the tip of the iceberg. And stick around because I have quite the surprise for you. That's right, you, at the end of this video. As always, I have to say, I'm an engineer. I'm biased towards investing in innovation. So usually I lean towards strategies that take advantage of innovation, companies that are disrupting technology in some way. I'm not an expert trader, not a day trader by any means. This will not be a video maximizing the algorithm. This is designed to be as compact and concise and to bring you as much value as I possibly can within the next 10 minutes. So with that out of the way, let's get into the conversation. We're gonna break it up into 4 parts. So first things first, we already know 80% of the market is determined by machines, by systems, not people. And that 80% of the market is broken up into 3 more categories: HFT, high frequency trading, passive indexes, and retail algorithms. HFT and RAT, what is going on? What are we talking about? Let's describe HFT first, high frequency trading. These are gonna be institutions that have literally spent millions and millions of dollars to build out this super connected computer infrastructure that can process all sorts of information faster than you can blink. The rate at which they can process data is literally their entire edge. They position their buildings near these data exchanges to get the stock data information much faster than anybody else. The less latency, the better chance they have to take advantage of the smallest discrepancies in the market you could ever imagine. And when I say minor discrepancies, I'll give you an example. If the temperature is forecasted to increase by 1 degree tomorrow, then you can bet that the energy pipelines beneath the surface will be slightly warmer and allow for energy distribution to be a little bit faster, which in turn will decrease the price of energy distribution by about 0.0001 cent. And with that information, a trader can take advantage and be right just about 100% of the time. They can make trades based on about any information you could possibly fathom. Whether you eat a bagel or cereal in the morning might impact your decision. They probably have that data somewhere, okay? That's not to scare you, it's just to say that this is the real deal. And if you think you can outperform them on this time frame, you're nuts. Luckily for you, this is just about 45% of trading volume. And I'm gonna break it to you. We ain't trying to outperform these guys because it's actually impossible. You don't have the infrastructure to pull off what they're doing. Their competitive edge isn't price data, it's latency. How fast can they get data and take advantage of statistical arbitrage? Thank God we don't have to worry about them. Can't worry about things we can't control. What about this 25% of passive index funds? Simply put, they track or emulate another fund. So if Jimmy is creating a fund that follows the S&P 500 and the S&P 500 has, 7% of its shares allocated to Nvidia and Jimmy's fund currently only has 6%, then the machine is going to sell off other assets in favor of increasing this Nvidia allocation to 7%. Now, this is a rule that a machine follows. The whole point of these funds, 25% of volume, is purely to emulate another fund. You're not going to outperform the market, you'll just perform in line with the market. And this is where RAT, retail algorithmic trading, is going to come in handy. Simply put, the ability of someone like you to take advantage of systematic things, systematic events that happen in the market over time. No fear, no greed, no human emotion, just data. And not competing with the HFT guys. Number 2, here's our example. Let's take advantage of a process that happens every single quarter systematically based on a rule. This is something that we know. It's open source. It's available for everybody to see. We can look at how do stocks usually perform leading up to their inclusion into a major fund like the S&P 500. What does that mean? It's important to note here that to take advantage of any of these strategies, any of these systematic things that happen over and over again, we have to understand the logic, the market dynamic, the actual machine thing that is happening. In this example, the S&P 500, the intent of it is to collect the 500 largest companies by market cap, so that way investors can expose themselves to a large basket of tickers in hopes that the 500 biggest companies over time will continue to innovate. Maybe they will change. Maybe some will be excluded over time because they fall out of favor for whatever reason. Their technology becomes obsolete. But because this dynamic is constantly shifting, a company like Nvidia was once a penny stock. Believe it or not, as this stock continued to appreciate and skyrocket over time, it became one of the top 500 largest companies, and that means it had a bid for the S&P 500. And this is where the logic becomes extremely important. When Nvidia is to be included in this S&P 500 fund, that means that those passive investing fund managers also have to add Nvidia to their portfolio. What does that mean? Well, that means that people are going to go out and buy Nvidia stock. So this is great. Let's just buy a company the day that they're included into the S&P 500. Sounds like easy money. You thought it was going to be that easy? It's not. I can promise you that. It is profitable over the past 5 years, but these traders, this other 20% of the human population, they're getting smart. A lot of people are starting to learn how to take advantage of systematic things, events that happen on a day-to-day basis. And that other 10%, the retail algo, they're certainly paying attention to things like this. When there's edge to be had, eventually it's going to be taken away. People are going to take advantage of it. The goal is you find it before they do. And ideally, you can take advantage of it forever, for as long as it exists. Here you can see buying the day of inclusion yields you basically zero edge over the market. Yeah, there's some big trades, but an average return of just under 1% and your win rate just above 55%. Pretty even distribution of losses to wins. This is where we have to think outside the box a little bit. Now, if we know Nvidia is slowly moving up the ranks of companies by market cap, then we can also anticipate the companies that could be included into this index soon, which means a lot of passive index buying, which means a lot of retail algorithms triggering, and hence means more price appreciation. But what this also means is a lot of other people also see this and can take advantage of it. People are smart. Now they try to price this in ahead of time. These are your results buying 30 days before the inclusion of the underlying asset. You can see the results are absolutely ridiculous. We're looking at 61 events over the past 5 years, just about. Average return of almost 7%, win rate of 72%. And some of these returns are absolutely monstrous. This difference is infinitely better than buying the day of inclusion. So traders have gotten so good at pricing in this data before it actually happens that you actually have to go out of your way to anticipate these events before they actually happen, which, yes, makes it all that more difficult. But did you really think it was going to be easy to make bread in this market? No. And so 3, how can we use information like this to reverse engineer the process? Well, remember, in an example like this, we have 25% of the trading volume just dedicated to buying Nvidia upon inclusion into the S&P 500 index. We also have algorithms that are triggering based on that news as well. But even on top of that, here's where the edge really gets amplified. You can imagine the passive indexes and the retail algos are the ones actually identifying the different systematic things that have to happen in this market for whatever reason. But then you have the humans, you have fear, greed, you have riding hype and selling out of panic. These dynamics amplify signals and algorithms that already exist in the market. Again, we can't compete with the HFT guys that are paying, $100,000 subscriptions to get data on a microsecond cadence. We got to work with what we have. We're not doing 150 to 300,000 trades per day. I think over the past year, this account has had anywhere between like 50 and 100 trades, all of them based on some strategic, systematic advantage. So with all that being said, how can you engineer your own advantage? Well, obviously you can just use the one I gave you. Once you understand those dynamics and the flow of money caused by those dynamics, we can just test. In this case, we can get inclusion data from Wikipedia. We can paste it into ChatGPT to organize it into a nice table for us to copy and paste into your gift and probably what you figured at this point, this platform here, MarketsPredictor. I'm not going to go ahead and give you a full tutorial on the capabilities of this platform, but the whole idea is you test your hypothesis, your strategy, whatever it might be, on a daily time frame. It doesn't have to be anything crazy. A daily time frame, that works. It can be anything. Maybe you think that Nvidia tends to perform when you buy on Fridays and sell on Mondays. Maybe history has told us that they usually leak some critical information, some very bullish news over the weekend. We can simply select that day of week strategy on the MarketsPredictor platform and see what is the reality. Clearly, that has been pretty damn good. I didn't expect it to be this good. Again, this is why you have to test it to see if the edge actually exists or not. And at the end of the day, about 99% of traders, not investors in this case, if you're an investor, you can still take advantage of systematic edge that exists in the market based on some of the dynamics we just talked about. But purely talking about traders, 97% lose money. That is insane for a market that virtually goes straight up over time. Only 1% has predictable profits. All that means, very simply put, is you use statistical analysis to tell you that this edge isn't luck. It's proven based on statistics. Like I said at the beginning of this video, you don't have to have any statistical analysis degree or complex mathematics knowledge to run these simulations because it's all done for you. In this case, this strategy has proven edge over time. You can see over 500 simulations, you're winning every single time. You started with $100,000. In the best case scenarios, you're up over 470%. That's pretty good. You can test all sorts of strategies, get an understanding of exactly what you're testing in the first place, and then see if it works. And if that's too overwhelming to start, which I know it was for me, trying to scan through virtually limitless information and choose what information to try and take advantage of on its own is stressful. So if we navigate to the live signals tab, you can see some of the signals that are triggering right now. These are things that you can test with the click of a button, or you can pin it to your dashboard to see, hey, maybe I want to check out this signal next time. And when you go to your dashboard, you're going to see, hey, that signal is triggering right now, this engulfing low. It's usually a bullish sign. And tested over years on a variety of tickers, you choose. And subscribe and like if it brought you any value whatsoever. Steal this strategy. I don't care if it gets arbitraged away. We'll find something new over time. The point is there's plenty to take advantage of. Just make sure, for the love of God, you're not trying to compete with the institutions that build their data centers right next to exchanges to get the best data possible. Take advantage of the data that's available to you. There's a lot of it. You just need to do some testing. And at the end of the day, if you're a long-term fundamental investor, you can continue to do that. The point is the market is more volatile than it has ever been. As we saw, Trump can send out one tweet that absolutely tanks the market, send out another tweet like 4 hours later that skyrockets. There's information overload out there. And if you want to take advantage of some of these dynamics, you need a system that takes advantage of about half of the market. You don't even have to compete with the hedge funds if you don't want to. The emotional human traders will only amplify this effect. Let me know what you think. I've designed this platform specifically for you. If you watch this video to the end, I promise you will derive some value from this platform. And if you don't, for whatever reason, let me know why it sucks. That's much appreciated as well. All right, thanks for watching. If you want me to put out some more content similar to this, let me know, and I will gladly find some more edge on your behalf. I'll see you in the next one. Bye-bye now.